Dear friends, welcome back to PMS Insights. In the last month of financial year, Indian markets staged a strong comeback boosted by increased FI participation to the tune of $4.8 billion after having a relatively sedate 2018 largely due to global macro factors. To put things in perspective, total net FI flows in Indian equities for the last 2 financial years was just $3.4 billion. After a year, we are seeing participation of the broader market as against the unprecedented divergence that was seen in the Indian equities last year, which is also getting reflected in the healthy outperformance across our PMS portfolios, which have decent exposure to mid and small caps. The next 2 months would largely be dominated by politics, after which we expect the market to rightly focus on India Inc.'s earnings growth trajectory, monsoon impact on consumption and inflation, global growth slowdown concerns, and rising crude prices. With Nifty's valuations not being cheap at 23 times trailing earnings versus last 10-year average of 19 times, earnings growth would become the key driver of equity outperformance over the next 1 year. Macro backdrop continues to be positive with benign inflation, easing interest rate cycle, stable currency, and improving corporate credit cycle. However, slowdown in auto sales, consumer durables, and muted commentary from FMCG companies are pointing towards moderation in consumption growth. In this backdrop, bottom-up stock picking with focus on micro-catalyst would be the best way to create wealth for investors. Within sectors, we continue to like select corporate and private banks and strong promoter-backed NBFCs, which should be the biggest contributor to earnings growth for the next few quarters. There are some structural plays taking shape in the corporate and private banking space, with the NVA provisions largely accounted for, leading to better earnings expectations in FY20 and 21. As of February 2019, bank credit growth was reported at a robust 15% year-on-year, which is a positive data point. Moreover, an easing interest rate cycle should augur well for the financial sector. We also maintain a constructive view on consumption and retail, even as commentaries from management point towards moderation. We have made incremental changes to the portfolio, adding high-quality names with strong management, which is also reflecting in the positive portfolio performance in the last few months. While 2018 has been tough for portfolios with mid and small cap concentration, we have been continually highlighting to the investors to stay invested with a 3 to 5 year horizon. Our portfolio positioning with focus on high quality names, low leverage and healthy earnings growth visibility should help create outperformance in the medium term. Thank you.